Hello and welcome to KLM Institute.
Today, we've got some serious news to dive into, and it's all about the wildfires that have been ravaging Los Angeles. These wildfires have been one of the most devastating disasters in California's history, and they're not only impacting people's lives but also shaking up the financial world. Let's break down everything that's happening, how it's affecting insurance companies, and what you need to know about the financial aftermath. So, what's going on in Los Angeles? Over the past week, wildfires have engulfed some of the most iconic areas in the city, including the Hollywood Hills and the luxurious Pacific Palisades neighborhood. The wildfires have already claimed the lives of at least 10 people, and nearly 10,000 structures have been destroyed. And it's not over yet. Though the winds that helped fuel the fires have eased up a bit, forecasters are warning that strong gusts could return over the weekend, which means the fires might still be a threat. Firefighters have made some progress, but the full scale of the destruction is still being assessed. Now, you might be wondering, how much is this disaster going to cost? Well, analysts are estimating that insured losses could hit as high as $20 billion. Yes, you heard that right, $20 billion. Some analysts, including those from J.P. Morgan, have even doubled their initial forecast, while others, like Wells Fargo, believe the total economic toll could surpass $60 billion when you factor in business disruptions and other damages. This could potentially make the Los Angeles wildfires the costliest disaster in California's history. Experts believe the economic loss, including uninsured damages, could be in the range of $135 billion to $150 billion. That's staggering. But it's not just the immediate destruction we're talking about here. This kind of devastation means long-term rebuilding efforts, recovery time, and, unfortunately, higher costs for homeowners and businesses in the future. Speaking of homeowners, California's insurance market is already facing significant challenges. The state's property insurance sector has been grappling with soaring costs due to the increasing frequency and severity of natural disasters like wildfires. In fact, some insurers are even pulling out of California altogether due to the unmanageable risks involved. This is one of the reasons why many experts are warning that insurance premiums are likely to spike in the coming months, especially for homeowners in high-risk areas. To try and provide some stability, California's Insurance Commissioner Ricardo Lara has stepped in with emergency measures. He invoked moratorium powers to suspend all policy cancellations and non-renewals for a year. This means that homeowners won't have to worry about their insurance policies being canceled or not renewed while they're still recovering from the fires. Lara's main focus is ensuring that wildfire survivors receive the insurance benefits they deserve as quickly as possible. If you think insurance companies are unaffected by this, think again. U.S. insurance stocks have taken a hit in response to the wildfire devastation. The S&P Insurance Select Industry Index dropped by 3.2% on Friday, and some of the biggest names in the business saw their stock prices tumble. For instance, Travelers fell by 4%, Mercury General, based in Los Angeles, plummeted by 22%, while Allstate dropped by 7%. Even international insurers like Beazley and Lancashire saw declines in their stock prices. Mercury General has said that it's still too early to determine the full extent of the losses. However, they've acknowledged that the losses from the fires will exceed their reinsurance retention level of $150 million, meaning that the company will be on the hook for a significant portion of the damages. It's going to be a tough time for the insurance sector, especially given that these catastrophe losses have become more frequent in recent years. It's important to understand why this is happening. The insurance industry has been facing mounting losses due to natural disasters. From wildfires to hurricanes to floods, insurers have been paying out large sums to cover the damage. As a result, many insurance companies have been pulling back from high-risk areas like California and Florida, where the risks are simply too great and the regulatory environment too challenging. For instance, California has strict regulations around pricing, making it hard for insurers to adjust premiums to reflect the growing risk of wildfires. And this brings us to the bigger picture. The insurance market is tightening. As a result of these wildfires, many insurers are now rethinking their strategies for covering high-risk areas, and this may lead to fewer options for homeowners. As more companies leave the market or raise their prices, residents in wildfire-prone regions may find it increasingly difficult to afford coverage, or even to find a company willing to insure them. This is a real concern for many people living in areas like the Hollywood Hills and Pacific Palisades, where property values are high but insurance premiums were once considered relatively affordable. The economic implications of this disaster will be felt for years to come. Rebuilding efforts will require massive investment, and insurance companies will be forced to adjust their strategies. Homeowners, especially those in high-risk zones, will likely face rising premiums and more limited coverage options in the future. As a result, the cost of living in these areas could increase, and some residents may even be priced out of their own homes. All in all, the wildfires in Los Angeles have highlighted the growing challenges that both residents and insurers face in California. With losses potentially reaching historic levels, the financial fallout will be felt across the state, and the insurance industry will likely have to rethink how it handles high-risk areas. The aftermath of this disaster is still unfolding, and it will take weeks, if not months, for the full extent of the damage to be understood. So, as we keep an eye on the wildfires and the ongoing recovery efforts, it's important to remember that natural disasters are becoming more frequent and more costly. It's not just about the immediate destruction but about how we as a society, whether we're homeowners, insurers, or regulators, adapt to this new reality. Thanks for joining me here today at KLM Institute. Stay safe, stay informed, and I'll see you next time.